Did you commit to another CPA review course that just isn't aligned with how you learn? Well, spilled milk, baby. In the world of accounting, only one figure matters, and that's the bottom line. So by investing in Universal CPA Review, you're investing in yourself, and we promise to do everything in our power to get you the ROI that you're looking for by obtaining your CPA license. We know that purchasing a CPA review course is an investment, and we also know that spending all that money on a program that hasn't worked out sucks, and we want to soften that blow. Our Spilled Milk program will allow you to commit to Universal's Visual Learning CPA Review program at a steep discount. So reach out to info@universalcpareview.com to learn more about our program and what discounts you qualify for. Okay, so now we're going to talk about computer software costs. In your mind, this needs to be isolated from the other intangible asset topics that we previously talked about, okay, because the rules here are going to be slightly different. So we need to understand for financial statement purposes how this cost is going to get reported. And the answer is it depends. So are we building out this computer software to be sold or licensed to the general public? Or are we building it for ourselves, right? Is this software for internal use? So we're going to talk about two different companies as our examples so that you could better understand the two scenarios. So starting with scenario number one. So let's start off by talking through computer software costs for resale. So let's think about Medieval Computer Gaming Company, and they're coming out with a brand new computer game called Napoleon Times. And this is a new computer game to be sold to the public. Okay, so this company is basically allocating all these costs to developing this computer game. So all that development is obviously going to cost the company money, right? We're essentially building out this inventory. Okay, so when it comes to developing computer software for resale, we need to understand our timeline. Okay, so you're going to remember ECA, expense, capitalization, and amortization. So the key term to keep in mind is going to be technological feasibility. All right, so let's go through this first phase of the computer software intended for sale. So this initial first phase is getting our developer to build out our technology, right? They're going to be designing the video game. Okay, they're going to produce these mock-ups, we're going to send it back. Essentially, this is going to be the design phase. Okay, so they're also going to commence the process of coding and testing this computer game to make sure that it works. Right, so during this phase, the developer is going to go through the planning, designing, and testing of the product. And what you need to remember is that this is cost that is initially going to be expensed to the company's financial statements. Right, this is getting expensed to the income statement. All right, so they're going to be expensing until boom, they've reached what's referred to as technological feasibility. Okay, so essentially we're going to be doing this until we have a demo. Okay, so the developer is saying, take a look, what do you think? Do you have anything that you want us to go back and redo? Right, but the point is that it's reached this technological feasibility. Okay, so we're not just going to memorize words, we're going to learn what it actually means. So let's start by defining the word feasible. This is an adjective, and it means possible to do easily or conveniently. Okay, so technologically, this is now a product. So if it is now a product, technically, it's an asset on our books. So anything after this point is going to continue to be capitalized to our books, right? We're adding this on to the balance sheet. So now once it's reached this technological feasibility, all costs are going to be capitalized. And this is going to include costs related to producing product masters. This is also going to include any debugging of issues. Okay, so we're going to flush out any of those technology bugs and just any further testing that is going to be necessary. But the big point here is that we've reached technological feasibility. So this is an asset on our books. We are good to go. Okay, so now we've reached the E and the C in ECA. So what happens after we have capitalized all these costs? We will have capitalized them up to the point that we are ready to sell this product. Okay, so it's now intended for use. It is intended to be released for sale. It's now on our shelves, or however it is that we're planning to sell this computer game to the public. Okay, so at this point now, we are going to expense any additional maintenance costs. All right, but the most important takeaway is after we have capitalized these costs up to the point that it's ready for sale, amortization of these assets will commence. Right? We remember amortization of our other identifiable intangible assets. So the rules for computer software amortization is going to be a little bit different. And at first glance, it might seem like a bunch of crazy information, but let's just take a step back and zero in on what is likely to be asked. Okay, so once we've hit this point of amortization, we need to, like we said, understand how this is going to be amortized. So when you remember that this is computer software costs that are designed for a product to be sold, like this computer game, we need to remember that amortization is going to always be based on the greater of the percentage of revenues method or the straight line method. Okay, so what we're going to do for the percentage of revenues method, because this might sound a little bit foreign, is take the total capitalized amount, right? All those capitalized costs up to the point of which the product is ready to be sold. And we're going to multiply this by the total current revenues, okay, so the revenues in the current period divided by the total estimated revenues, right? So generally this is going to be provided. The total estimated revenues is basically the amount that we expect to earn from this computer software. Okay, so again, total current revenues divided by total estimated revenues is going to be multiplied by the total capitalization amount. All right, and we remember the straight line method. We're just going to take the total capitalized amount and multiply it by 1 over the estimated useful life. The annual amortization expense, like we said, is going to be the greater of the two. And now let's talk about scenario number 2. And that's going to be computer software that is intended for internal use. Okay, so let's now introduce you to our next company, which is Lady Tax, right? The future is female. And this female-owned tax firm not only has their global book of clients, but they also design their own in-house tax software. All right, so let's say that they don't plan to actually sell this software or license it out to other firms. Right? Tax software is expensive, so they think that they're cutting costs by designing their own. So for financial reporting purposes, what you need to know for the exam is how these costs are going to be reported. So when taking a look at this timeline, keep in mind this is going to be very similar to computer software costs that are intended to be sold. So in the initial phase of developing this software, these ladies are going to go to their tech team and say, hey guys, here's our idea for our software. These are our needs, and this is how we need to get it done. Okay, so the tech team is going to be in the process of development until they have hit, once again, this technological feasibility. So it is at this point where they have decided that it is an asset on our books. Okay, so this is the demo that is ready to be showcased. So this is when we're going to begin, once again, capitalization of the asset on our books. So this is going to include any costs related to reaching the product development stage. Okay, so this is when we do the software configuration, the coding. We're going to be installing any necessary hardware and doing any further testing until the software is ready for its intended use. Okay, so again, at this point, this is where we will begin amortization. All right, but amortization here is going to be a lot more simple. We're just going to be amortizing this by applying the straight line method, right? Unlike a situation where we are selling the assets, this is not going to be the greater of the percentage of revenues or the straight line method. Once again, just going to end up using the straight line method for amortization. But now let's say that Lady Tax instead decides to go ahead and sell this software or license, right? It decides maybe it's not the best business decision to just use this for internal use. Let's go ahead and sell this or license it to other tax firms to generate additional revenue. So let's now say that the company is instead generating revenue by subsequently selling this software to Allen and Glenn CPA PC. And in this situation, what you need to know is that revenue is going to be recognized by applying the cost recovery method. And the cost recovery method is simply going to be recognizing revenue after all the initial costs are first recovered. So the calculation is going to be the proceeds from the sale of the software over the net book value of all costs incurred. Okay, so at the end of the day, both of these are very similar, right? There are some slight differences that we need to be conscious of. Okay, so the big one's going to be amortization. When it comes to amortization of computer software costs that are intended to be sold, we're going to take the greater of the percentage of revenues, which is just the capitalized amount, multiplied by the total current revenue divided by the total estimated revenue, or the straight line method, right, which is just the capitalized cost multiplied by 1 divided by the estimated useful life. If, on the other hand, this is computer software cost that is intended for internal use, we're just going to apply the straight line method. All right, and just that sneaky last topic about recognizing revenue. When it comes to computer software costs that are intended for internal use, we're going to recognize revenue by applying the cost recovery method.